Hello everyone, this is Calvin Professor C here. So today we are going to take a look at mortgage pre-approval, and more importantly for the client who want to know whether they would approve for a mortgage or not. So let's go. So recently, the market is heating up, the real estate market is heating up. A lot of people are trying to totally understand and feel confident that whether they are able to qualify for the mortgage before they put in the offer. And a lot of phone calls from many different clients this week, and I decided to make a video to help some of this client and hopefully help you to help your client so that they can actually do the pre-approval themselves. Out there are many tools, many calculators online that they can kind of do it and use it, but a lot of the time the calculator are too simple, so that they just give you input your income, and then afterward they come out and say, yeah, you qualify or not, right? So they don't actually give you the meat inside how they calculate it. And the reason why you want to know how they actually come out with an approval or not, I think this is important because not everyone's situation is the same. Sometimes that calculator is a vanilla type, like just give you the general idea. But what if your situation is a little bit different, right? Then that's I think the best thing is what's exactly running in the calculator, and then you can adjust it to your own situation. So if you are a kind of your mortgage agent watching this video, keep on watching to the end, and then you will know whether you will be able to pre-approve for your mortgage, and then you don't actually have to call your mortgage agent. You save their time, you save your time, you feel confident going in when you put in the mortgage, the real estate offer. Okay, so first, there are many factors affecting the approval process, but one of the most important factor is whether your income would qualify for the mortgage that you are seeking. So the first thing you need to look out for is you need to know how much you need to borrow, which is the mortgage amount. So that one is easy. Say that you find a house that is $1 million and you have $300,000 cash lying around that can be used as a down payment, and basically the mortgage amount is $700,000, right? So the first thing you need to find out is, okay, for a mortgage amount of $700,000, how much is the mortgage payment? So the first thing you need to find out is the mortgage payment, and this is usually the most difficult part of all the calculation. How do I know how much is the mortgage payment for a $700,000 mortgage? For that, you can go to a mortgage calculator online. This is actually, one of my mortgage calculator. As you can see, there's my name there. I will have the link in the video description, so you guys can just click and you can save it as your favorite page and all that, so next time and every time you can use it. Okay, so how you do it is, property value is $1 million. Down payment is $300,000. So the term, it doesn't really matter, right? Interest rate for now, if you're watching this is right now May 30th 2019. You use 5.34, okay, as a standard. This is, I would say, for pre-approval purposes, this is good enough. There are a lot of things going on in the, in the interest rate, that why you should put 5.34 and all that stuff. I will tell you in the next video about the B20 rules and all that stuff. But for now, just remember 5.34. For the amortization, just put 30 years. So after that, look at 3,879.11 per month, right? So that's the monthly payment. So that's the monthly payment that we are talking about. Okay. Next item you need to know is property tax. Property tax is, it's easy. If you're buying a resale property, you look at the MLS listing, and you just basically, it is there telling you, right? So say that, just go MLS listing, and then you can just click there, and let's just look at it. This one, tax 1,789 whatever. So that's the tax, right? So you just basically divide it by 12, then you know the monthly property tax. So if it is a condo, either a condo townhouse or a condo apartment, there's condo fee. So for example, this is a condo apartment. Where you find the condo fee, this is the condo fee. It's a MAINT, that is maintenance fee. So it is the same as condo fee. So this one. So you basically use half of the condo fee. Now, this one is assumed that you are buying this property as a principal residence. This is usually how the bank look at it. 50% condo fee if it is a principal residence, okay? And if it is a house or semi-detached and all that stuff, it doesn't have the condo fee, just ignore this part, right? Just ignore this part, okay? And lastly, you need to add $100 heat, right? This is, usually the big five bank right now is they usually add $100 heat to your monthly payment. So you add up all this, right? So 3,800 something, this one assume is 1,500 per year, so it's about $100 per month. 50% condo fee, the heat, then you divided these numbers by your monthly income. Your monthly income, okay? So say that you are making $36,000 per year. So that monthly income is $3,000 per month. Now we use gross income, and all the banks use gross income, so you don't have to worry about how much is your net income after tax going into your account, all that stuff. Don't worry about it. We use gross income. So this is called the GDSR, or the gross debt service ratio. Okay. The next one you need to know is, you just basically need to know two things, right? The GDSR and the TDSR, the total debt service ratio. This is even more important. What is this? This is the GDSR, which is this, okay? Or this, is all the payment, the mortgage payment, the property tax, the condo fee, and the heat. Plus, if you have any car loan or car lease payment and all that. And if you have any credit card outstanding, right? This credit card payment is a little bit tricky because a lot of my clients say, hey, I pay my bill on time in full every month. Every single month, I pay every single dollar of my credit card bill on time. Does it mean that I use zero as this credit card payment? And the answer is no. The bank would look at the credit bureau and say that, okay, Calvin, you have, say, $1,000 outstanding. We will assume that every month you have $1,000 outstanding. So they will use 3% of your outstanding balance as your monthly credit card payment. So say that you come to me and pull a bureau on May 30th, 2019, and you see $1,000 outstanding balance on the credit card. Even though I may pay off in full tomorrow, June 1st, it still doesn't matter. Whatever is shown on the credit bureau that is outstanding, they just treat that as an average monthly balance. So this is a little bit tricky, and so we use 3% of your outstanding balance. Okay, so if it is $1,000 outstanding, we treat the credit card payment as $30. And if you have 3 different cards of the same, of that, say that you have three cards with $1,000 outstanding, then each card is $30 monthly payment, and so it's $90. Okay. And so since we're on this topic, one of the tricks that you can get yourself a better chance of approving the mortgage is pay off every credit card you have, say a week or 2 weeks before you go to see your mortgage brokers, so that you make sure that the credit bureau, it shows zero balance, and so then you have a better chance of getting your mortgage. Okay. And lastly, some others, what other stuff you need to add here, say that you need to pay alimony payment, you have some unsecured line of credit. Unsecured line of credit, you use 3% payment, right? But say that you have alimony that you need to pay, you have student loan, you have some other stuff, you just add it here. Okay. So this divided by your monthly payment, it comes up with your TDSR, right? The total debt service ratio. So after you calculate this two, assuming that you have a good credit and how, you usually have a gut feeling how good your credit is. If you always pay late on your bill, then you probably don't have a good credit. But if you always pay on time, all that stuff, then you have a gut feeling that you have a good credit. And if you want to know how to improve your credit, watch my previous video, the one that I taped last week. Okay, but this is the conclusion. If GDSR is less than 32% and TDSR is less than 40%, perfect. You almost pre-approve yourself, because this is what the bank do too. They look at this, they and they give you a pre-approval without checking your credit, right? So that's why this is perfect. This is basically the industry guideline. If your GDS is less than 32 and TDS is 40, you can basically go ahead and take a look at putting in an offer and buying the house without even calling your mortgage broker, because this is perfect. Unless you do your math incorrectly. Okay. If your GDS is less than 34 and TDS is less than 44, yeah, you're probably okay. Unless you are going into like very weird situation, most of the time you are okay. Some other factors that they look at is whether you have other after you pay all your down payment, whether you have other cash left over and all that stuff, but under normal circumstances, this should be okay, and you should feel confident to put in an offer, maybe just with 3 days financing or something like that. It should be fine. Now, if the GDSR is more than 36% and TDSR is more than 46%, this, I don't know, this is very marginal. I would not say that this is impossible, but it doesn't look good. And lastly, if your GDS is more than 40 and TDS is more than 50, I suggest first go to take a look, talk to your mortgage broker first, because this is a very difficult case. I will never say never, but you better have a very, very long talk with your mortgage broker and explain to him why you think you can afford to pay the mortgage payment, because this is over the industry guideline and over by a lot. Okay, so this is basically what you get when you go to, say, a pre-approval, those online pre-approval stuff. This is what they do. They basically ask you your income, and they ask you, what's the property tax and all that. This is basically what they do. They just don't tell you what they are doing, but this is what they are calculating: the GDSR and the TDSR. Okay, so there you have it. Now, if you're a client, you feel much more confident going into buying a house. And if you are a mortgage broker or agent, you know what? Go and suggest your client to watch this video so that they don't actually have to call you for a pre-approval, because then they save themselves some time and they save your time also. So it's a win-win situation. Okay, so there you have it. If you like what you watch, either as a client or as a mortgage broker, then click below and subscribe to my channel. My channel is all about helping new mortgage agent making more money and faster. If you like that, watch my other video, and I hope you make tons and tons of money. Okay, so see you then, and until next week, I will stay tuned. Okay.